We are live.
Okay, welcome Portfolio Builder members. Today we are, I'm sure, a little nervous. We were up, many people were bragging about being up 100, 200 grand. And then with a historic move up in the TLT, it was the single largest drop in rates in history. And by my diagnostics, I believe that there's two things going on causing this pullback, really three. Number one, a lot of people took profits on that position. One, two, the stock market crash is crushing people who thought that they could leverage into equities and that really trusted that coronavirus is not as bad as the flu and that there's nothing to worry about. And three, I do believe the central banks at this point in time are trying to punish people making the smart bet, which is what we've had to hold into, which is drawdown, while they incentivize trying to trick people back into stocks ahead of a catastrophic event. There's certainly something sinister going on. I've been trying to get to the bottom of it. I don't have a clear answer. In our pro group, I'll give you tomorrow all the popular conspiracies I've dug up, so we can try to make heads or tails out of it. What I believe happens next are lockdowns in Los Angeles, New York, and Washington State, and a true panic very, very soon. This potentially happens in the next week or two. Best thing to track from my point of view is watching what's happening to Italy right now. So I'll save that sort of trail of crumbs we have to figure out what's going on for our Thursday webinar. Let's review what's going on with this trade alert. So the bottom line is the US government has a catastrophic healthcare event, as well as bankruptcies in many different industries all happening at one time. This is all unfolding. People are still having a hard time grasping what's happening because our officials are telling us one thing, but if you do just the tiniest bit of research, you can tell something completely different is unfolding. So today's trade alert assumes that the government is going to need to borrow a lot of money, and I'm talking trillions of dollars. And in order to do this, they're going to have to incentivize investments into US treasuries. And they do this by cutting interest rates, which drives the yield lower and makes the relative bond price higher. So I believe they're going to have to raise more money than they ever have in history. And that's going to put a huge drag on the US stock market as well as other global stock markets. So when you understand that there's limited resources in the economy and that because of the panic unfolding, money should flow into treasuries. And in order to incentivize that and to prevent everyone from running for the hills in their bond position as yields get lower and lower, that they will have to artificially drive bond prices up through federal funds rate policy. To further back up this assumption, we're also seeing them not ramp up quantitative easing, but rather repo. So repo is spiking to all-time highs this week, showing that the banks are stressed. And without the repo, they would have to be selling their treasuries to be able to have enough cash to operate. So the repo market, I expect to expand very quickly in the coming weeks, which will allow the primary dealers in the United States to pick up all the treasury auctions, lend it back to the Fed with what they call repo, which allows them to essentially have a double payday. They can hold on to that bond, collect the interest, and then also sell it after the crisis is over and rates have been artificially pushed much, much lower by the Fed. That's when I would expect the real QE to come in so that they can just sell the treasury straight to the Fed. That's really their playbook. When you have a crisis with business, you need to cut interest rates. And then once the crisis is over, you support the government by doing QE. So rate cuts usually indicates a stock crash and a appreciation in bonds, while QE is usually used after the crisis is resolved, and then that supports the government and you get falling bond prices and rising equity prices. So we can see this is all playing out. It's unusual for the SPY to be down today and TLT not to be going up. But the bottom line is that they are going to have to raise likely trillions of dollars to fix this current issue. That money has to come from somewhere. It's likely going to come out of the stock market. And they must incentivize investors to not just buy the bonds and flip them, but to buy and hold them for appreciation. So with that in mind, remember Friday and Monday, I warned you that they would do everything in their power to disincentivize early investment into the next big move. And we've seen them do this several weeks in a row. This was quite a move to the downside in the TLT yesterday. But my expectation now is that the TLT will go dramatically higher. And after evaluating this very carefully, I think the ceiling is much higher than most investors believe possible at this point in time. And so it's simply a miscalculation of the magnitude of the crisis unfolding that will trick investors into potentially exiting their TLT position far too early. So once again, in our basic membership, which we're covering today, where we trade Monday, Wednesday, Friday, we don't get into all the details of this. We just give you the trade alert on a silver platter, and you can enjoy it. So let's just go through the trade alert from head to toe, and then we'll look at some charts. Then we'll look at what's going on around the world on my Twitter feed, which I've retweeted the most important articles and items, and then we can go into Q&A. Okay, so we really have two core groups. We have people following the SPY program, which we referred to as the basic membership, that trades Monday, Wednesday, Friday. And despite that pullback, we're still up. Well, we were up 5.8%, did pull back a couple more dollars. We're probably down a couple percent from there. Not worried about it, guys. I think the big push is coming into next week, and we have tons of time premium on all our options. So I do suspect we will outperform where we were sitting at on Monday in the very near future. And unfortunately, this move could last much longer than investors anticipate. Originally, I was hoping that this would all be over by sometime around July or August, but unfortunately, that really does not seem to be the case. Okay, so if you're in our basic program, either a paid customer or on a free trial, you get trade alerts and webinars Monday, Wednesday, Friday. Now, normally we'd be trading the SPY ETF, which is the S&P 500, and it has option expirations every Monday, Wednesday, and Friday. But currently, this is literally a once in a century event that is unfolding before our eyes. And I believe that we can enter the SPY at a far lower price because of the massive manipulation happening to the US stock market, trying to keep it from crashing in just one foul swoop. It's become incredibly difficult to trade in either direction. So what is more clear of an investment strategy at this point in time is understanding that the crisis unfolding is too large for individual banks to absorb the losses. It's far too great for our healthcare private system to absorb the coming cost to provide healthcare to potentially millions of people being infected with the coronavirus. So the bottom line is the US government must borrow money, massive amounts of money. This is a global problem. So all governments are going to have to go into a massive borrowing spree to fund bailing out companies that are being wiped out by this economic slowdown, and to help provide healthcare to people who will be a risk to society because they could be forced to go to work and continue to spread this disease. So when we understand that it's not just the United States, but a global problem, that they're going to have to collectively raise trillions of dollars to fix and absorb the disaster unfolding, then we can understand that the Fed must cut rates, and that we'll soon see all central banks slowly but surely cutting rates and potentially driving into negative interest rates. which means that the TLT can go far higher once again than originally anticipated. So what's all the noise? What's the pullback? Why are stocks jumping up and down? Well, once again, this move is creating bankruptcies and causing investors to liquidate their full positions, which tend to be a stock bond combination, perhaps with some gold in there. And so I think we will see that stocks are going to crash very precipitously in the very near future, and that bond yields have to go higher. And so it's going to be, you're going to have a lot of bravery holding into these positions as the market swings up and down, as people are getting liquidated. Also consider all of the banks writing put options when they go into a losing position have to cover by buying the S&P 500. That in itself causes a lot of automated trading systems to copy the trade, bounce it much higher, and then everybody starts selling once again. So I look at a staircase that's with the stairs slightly slanted up as what you may expect to happen in the S&P 500. And this is, again, until we can get back to business as normal, which may be quite some time. Now, from a strategic standpoint for the US and for the earth to survive this coronavirus, if it is as deadly as it appears to be, I don't think we really expect that we can prevent it spreading. That seems to have already occurred, and that bus has already passed. However, if we can slow down the spread, we can reduce the overwhelming overflow of patients that will be hitting the hospital system and potentially have less of a meltdown. So that's really the logic behind purchasing the TLT, which is your 30-year treasury. It goes up if yields go down. And once again, that is the go-to playbook of the Fed. So we currently have invested in a 320 TLT call, which expires next Friday. We'll be selling that at some point next week. We invested in the 327 TLT call, and we'll likely hold that into the week of expiration. And we've also purchased the 4.3 TLT call, which we will also most likely hold into that week of expiration. These were up as much as 700% on Monday. They're still up considerably. They have a lot of time premium, and they're in the money. So because I think the TLT is going higher the farther we go into time, it's in our best interest not to sell these at the halfway point of the time premium, but rather as close to expiration as possible. Okay, so today's trade alert is for every $30,000 following the SPY system, which is in cash, that we're recommending you buy to open the 417 163 TLT call option. Okay, so if I scroll down, we can see what that, here's your TLT chart, which I again believe is going dramatically higher in the very near future, which will be caused by massive fiscal spending. So the government must borrow tremendous amounts of money to try to absorb all the bankruptcies and the stress that will be put on the healthcare system. And in order to do that and incentivize that loan, we need the central bank to lower interest rates, which is coming up in, I believe, at the end of this month. But they may have to do an emergency cut far sooner. So here's a look at the option chain. Again, we are using the asking price. You probably got a better fill price in the mid, but I use the asking price. The strike is 163. For every $30,000 I wish to invest in the SPY ETF at a later point, when I believe stock market has bottomed, we're simply investing into one of these call options. So it's a $730 investment relative to $30,000 in cash currently if you're a new subscriber. Now, I do not recommend that you go back in time and take previous trades. Simply buy the trades, trade alerts as they come out. Here's a look at our TLT chart. And the move we saw from February, which was right here, to current, is how far we could potentially percent change. It's about a 35% change. That similar move could be in the cards in the very near future if the 30-year Treasury yield catches up to the current 2-year yield. So I do suspect we'll soon see the short end of the US Treasury going into negative territory, which means the 30-year has the most leverage and potential profit ahead. Okay, so that's a review of the trade alert. Let's go through the track record. So again, if you're in our basic program, you're just taking option trades Monday, Wednesday, Friday currently, and have a large stockpile of cash. That cash is sitting back ready to buy the SPY when we do believe we've hit a bottom. So that's how this portfolio has performed, 14% in 2019. Largest drawdown were 3 months with up to 1.2% total loss. And then in February, 1.9% loss. And this is during a period where it was pretty easy trading, and anybody who just owned anything in the US stock market did very well. But as you can see in 2020, trading hasn't been so easy. Many people are really losing a lot of capital. It's very confusing. You're getting the media and the officials for the government telling you not to worry and to buy stocks. You got Warren Buffett going on TV at the very top saying he would never sell. And then you have this historic stock market crash unfolding. So you got to ask yourself, why are the people we trust telling us to buy stocks as it's crashing? So that's this strategy. It's done very well, but do keep in mind it has had 4 losing months out of a total of 16 months. But it's performed extremely well with approximately about 80% less drawdown than the S&P 500 had on its own. And that would be for 2019 and 2020. Obviously, it's completely knocked out all the drawdown relative to the stock crash. Now, in our Pro program, we better diversify your portfolio, and we put approximately 40% of your investment into the US Treasury markets with the actual underlying ETF, which will soon be the only safe way to really profit from what I'm expecting. The cost of options to bet on the TLT is just rocketing higher by the day, making it more and more difficult to use the option market. So people who are in our Pro program, you'll see that using the actual ETF has some tremendous benefits as this starts to spiral out of control here. Now, the Pro program is designed to really protect capital. It has done a fantastic job with only a single losing month and a single break-even month. So in November, we had a flat return, and in July, we had a negative 1% return. In 2020, it's currently up 6%. And again, I do suspect that the returns we were sitting on just 48 hours ago will be back soon. So we were up 15% on Monday and 12% from our call options appreciating significantly. And again, I think that the core underlying reason that the TLT has been appreciating is about to get much more attractive to investors. So we're a little bit ahead of the game predicting everything that's going to roll out. Now, remember, on February 1st is when I first started warning of this all unfolding. And so we've been tracking this very carefully. Now, if you don't have enough capital to follow the SPY program, which starts at 30,000 to buy 100 shares, we do offer buy and hold instructions. Our buy and hold portfolio is up 2.4% 2020. It's made very few trades and there's no change, but per $7,500 following the buy and hold, you would have $3,000 in cash ready to buy the SPY, or 40% of your portfolio. You would have 20 shares of the TLT, which represents just over 40% of your portfolio, and you'd have 20 shares of GDX, which is just under 10%. You'd have 10 shares of Yang, which is around 5%. And then we have another 440 ready to double down on Yang if the time comes. Now, GDX has been having a little drawdown and still investigating why. The fundamentals for gold miners, silver, and spot gold are all improving by the day. So due to the smaller position size, I've been willing to allow that position to have some drawdown and have not changed my analysis yet on how to play the gold and gold miner markets. Okay, so what I'm going to do now is look at some charts. Okay, so here's your S&P 500, clearly under attack. So if you're a technical analysis trader and didn't understand what was really going on, you might think this was a great buy opportunity. Last year, I would have thought this was a tremendous buy opportunity and did buy the dips aggressively for our clients. But this year, it's just not the same. The crisis that's unfolding is catastrophic and really something that we haven't seen anything of this magnitude since the World War I, World War II era. And it's not quite clear what on earth is going on. What is clear is that our officials are lying about the severity of this disease and the risk it poses on our economy. So that for certain is being misreported. So I'm trying to get to the bottom of why and what their intentions are. So my expectation is this will crash much farther and much longer than most anticipate. And because of the manipulation, once again, that the banks are using to try to protect their positions and slow down the crash, it does make it very difficult to trade the SPY itself. But if you understand the relationship between the stock market and the bond market, you know that the safe way to bet on economic turmoil is to simply buy the long end of the treasury curve, because we know the central bank's game plan is to cut interest rates. And this is exactly what they did with an emergency cut, and I expect they will soon do yet another. Here's that massive spike to 180, which pulled back, but I believe we're just getting started here. And the potential top I once believed would be in the 175 to 200 range, I am now starting to greatly question and believe it could go dramatically higher due to the sheer amount of capital that must be raised by the government. So we'll once again save that detailed analysis for our Thursday group. But that's the rhyme and reason to invest in the bond market. The government must borrow massive amounts of money to bail out the airliners, the oil companies, and the healthcare system in the coming months. And that money has to be stripped away from other markets. That market will be the stock market. So you can expect stocks to be punished and for the government to essentially force investment into bonds by just sitting there and lowering the federal funds rate. Okay, so let's look at the charts. We've been warning of this for quite some time. And what I want to show is the progression of the TLT versus the SPY. So on 3-2, we were warning when the SPY was at 300, last chance to get out, see how to profit safely. And you can see this is when we started recommending call options. Now, do I wish we'd taken some profits off when we popped to 180? Sure. But the caveat to that is that now these options are significantly more expensive. So if we do break past that high, which I think is very likely, we're actually going to end up making more money by doing less work than had we second guessed it and sold on Monday. Now, I know a lot of you guys did take profits on Monday, and I'm seeing questions about whether or not to double down or triple down. And so I'm not going to endorse that, but I do believe our opportunity to buy call options on the TLT are going to get more and more expensive over time. And so if you do choose to take greater risk than I'm endorsing on the current trade, then that's up to you. You're likely using profits, massive profits you pulled off Monday. So at least you can say that you're gambling with the house's money and not your own. So as we can see, we've been warning of this on 3-2. We were saying last chance to get out. We were trying to catch a manipulation bounce for several weeks by buying the SPY and purchasing a put. And the put saved our ass. We lost extremely little during this massive crash. We were 1 week from hitting the rebound. The cost of put options on the SPY are absolutely insane. And so there's no point in trying to, I saw your comment, Anwar. Yes, the same link will replay this. But bottom line is we're positioned perfectly for what's coming next. And there's very little changes in your portfolio. Okay, so here's the first warning, and we started building into this position. Next, I started showing you each day that the TLT, the bond market, and the SPY market are highly correlated, and that my anticipation is that the TLT on a price change basis would soon cross over the SPY. And so we're seeing this slowly but surely unfold. And I believe by next week they will indeed cross as the underlying problem is starting to get absolutely out of control. So let's go over to Twitter now. So the repo, we normally have a page of this, but I'm just going to go through my feed. They've dramatically increased repo markets, which is essentially expanding the supply of dollars. That's very bullish for gold. So we want to stay put with our gold predictions. Yeah, guys, so everybody's asking if they can rewatch this. If you go back to the same email with the link that got you here, after the webinar, it will replay automatically. Okay, so repo, oversubscription of repo means banks are out of cash. That puts them in a position where they either start liquidating assets into the market, which would further increase the problems we're dealing with, which is a financial crisis, or they can just simply hand over treasuries to the Fed in repo and get cash, and then later on they get their treasuries right back. So it's a sweetheart deal for banks. It incentivizes owning treasuries, helps keep the bond market intact, and then also allows the bank to loan money to broker dealers, which is typically going to hedge funds to buy stocks. So they're trying to keep the bond market from collapsing and stock market from collapsing at the same time. But this will have the effect of weakening the dollar and eventually pushing the value of gold up as well. So we're not changing our calls on the gold miners or the spot gold call options at this point in time. Just realize that some people are having to liquidate because of massive losses. And that means they just sell everything they have because of margin calls. So banks are stressed. They've dramatically increased the repo. I think this will soon be at astronomical repos in order to keep the bond market from collapsing on itself. There's some cover-ups. There's some scandals going on. Everywhere else in the world, they've been testing tens of thousands of people. They're allowing people to do drive-through testing. For whatever reason, our administration and officials seem to be corrupt or trying to delay a panic. But the cost of this is that it's helping the virus spread, and potentially our doctors and nurses will be infected, which raises the question, who's going to provide care if they're not even getting proper safety precautions for our own healthcare physicians? So if you go look at how the doctors are protecting themselves in South Korea, Hong Kong, or Italy, they're essentially in airtight suits. Meanwhile, our doctors at best may have a mask. It seems quite clear that this is a airborne, highly infectious, very deadly disease that, again, is not being illustrated this way by the media. So very concerning. I called my doctor last night because I have a dry cough and fever. Docs don't have the test kit. The Department of Health has them. Okay, so Pence told us Friday or Thursday that they would have 1 million kits delivered. And now in the congressional hearing, which I was just listening to, they're complaining that only 100,000 of them arrived. The previous kits had something wrong with them that they didn't work. So this is supposed to be the best healthcare system on the planet, most prepared for a pandemic, yet we've tested something like 2,000 people as of yesterday. Now, clearly that number is jumping, but what exactly is going on? Something sinister is certainly underway. So China is trying to say that there's no new cases, that everything's great. President Xi went to Wuhan, but no one could get within 15 feet of him. He said he was visiting a patient, but was with a webcam. And days before, when his second in command went to Wuhan, they were doing all those propaganda videos showing how safe it is, but yet people were screaming, it's all fake. I have anecdotal evidence that people in Wuhan have been locked in apartments for 50 days. There's videos of people getting welded shut in their apartments. So it's really just, you can see this huge line of people trying to get into this hospital, and they're trying to tell us there's no new cases. Meanwhile, the propaganda arm of China is now banning flights from America to China, which is almost comical, and criticizing how Western civilization, especially the US, is coping with the crisis, which I find interesting. Curious that he's even allowed to be on Twitter. Here's President Xi visiting, and once again, take a look at the precaution their doctors are using. Okay, it's like a spacesuit. So our hospital system is not using protection anywhere near that level. So my fear now is that this is the biolab that many believe this virus potentially came from. And again, you can see it's air protected oxygen. This is an airborne, this looks to be airborne, extremely infectious, and highly deadly with a very high level of complication rate. And for whatever reason, everyone's been telling us the exact opposite. In Iran, they've had to let loose all the prisoners because it was spreading so rampantly in there. Italy's in a complete lockdown. Here's jail in Italy. We're on the verge of complete chaos. So we're seeing little areas get into lockdowns in the United States. My expectation is that we will have to make the same dramatic moves that all of the other countries have had to do, not to stop the spread, but to slow the spread of the virus, which in turn helps us deal with the crisis at a slower pace. In this chart, we note that the 2008 crash had most of the crash delivered in only 4 trading days. So again, in 4 trading days out of an entire 1-year decline, the bulk of the losses were absorbed. And so we recently had a sell-off near the magnitude of 2008, but not quite. I think that that is in the cards very soon. Now, it's those circuit breaker drops that really drive a quick rush into the TLT that we've been seeing benefits from today. But the true unstoppable force that will drive TLT higher is going to be the requirement of massive fiscal spending to bail out everyone from oil to air to the healthcare system, which surely, and the insurance companies, because if we don't treat all the people getting sick, they become a public health hazard. So this is going to be just a monumental cost to society globally. So again, my expectation is all governments are going to be faced with the same predicament, that their private sector cannot absorb this. They must fund it at a federal level, which means issuing massive amounts of treasuries, and these treasuries need to show appreciation. That means they'll be cutting interest rates lower than anyone thought possible. Okay, so I think that's a pretty good overview of our outlook, how we're playing the markets. Let's go ahead and go back to the trade doc and do Q&A now. Okay, I'm going to go through the comments and then we'll start opening up. So I'm going to go from the bottom up. Mark Stoley says, I think Tedros finally admitted we have a pandemic. Yeah, the CDC appears to be completely corrupt. I really question the entire team that's working for Trump, starting with Dr. Fauci. Randy too thinks Karen, the action area, does not even have the options for manually self-covering calls. Karen says WHO just made another stupid comment. The market is moving down again. Yeah, economy is going to be crippled. So this is just the very, very start. Michael Seebeck says, I need to discuss my allocation strategy regarding my 401k and cash accounts. I have new information. I have been meeting this every. So Michael, it's very important that we are not a individual financial advisor. So any recommendations we really make has to be in a group format. So if you do want to talk live, I'm happy to walk through, because I think a lot of people have 401ks that they want general advice with. So if you're available to chat, let's go ahead and raise your hand so we can bring you up and we can go over that in detail. Roger says WHO declares global pandemic. No shit. But I'm glad they finally said it. But yeah, those guys, to me, should all be put in jail. Dan O'Connell with US 10-year at 0.82 and the 30-year at 1.3. Does that leave us enough room for the 20-year to go down? So first of all, Dan, there's no 20-year. They're going to add that soon, but it's not there yet. So we're playing the 30-year. Yeah, I think that you can expect the Fed to track the 2-year and for the 30-year to catch up with the 2-year. So I think the first move is the Fed will be dropping rates very quickly, which will drive the 2-year even lower, and that the 10-year is going to, or the 30-year is going to go much lower. So think of the German bond that had a negative rate last year. That's what's going to happen globally. Anwar said he had to leave. I'll catch the recording. Yes, sir. It will be ready to replay. DD, if we took profits on the earlier TLT expiration date, can we go in today's trade with extra option? Yeah, so if you're playing with house money, you have some extra money. I'm highly confident that this is the outcome that must occur for nations to survive. They must fund this crisis. They must raise trillions of dollars to do so, and they're going to have to incentivize that investment. So I'm very confident in this trade alert. Okay, Randy 2 says Fidelity had to submit options authorization. Okay, good. Only comment for you, Randy, is I would just take the trades as they come in. So if you're not prepared yet, then just wait for the next trade, because then we can use the best information at that time and not try to track back in time. Okay, I'm still catching up with all the content up above. Anwar said GLD went down. Yes, I think gold must go up. So if we have to expand, I think what we're going to see in the short term is expansion of repo and lowering interest rates, which is a form of quantitative easing that's designed to protect the bond market and incentivize buying and holding treasuries by banks. So I do think that right now the TLT will outperform gold, but I do think gold's going to rally. But after really carefully analyzing just how much this really could cost, it's going to be trillions of dollars, trillions and trillions of dollars. So that money has to come out of somewhere. And that's really the big event of 2020. Okay, let's start with Michael Seebeck. He has his microphone open. Go ahead.
Hey, Jason. Can you hear me okay?
Yes, sir.
Okay. Yeah, I'm not looking for trade advice. I understand your position and I appreciate that. It's more or less just getting started as a paid subscriber.
Yep.
And when Dean and I spoke last week, I really didn't understand all the true nature of plugging in. Where do I plug in? Dean, you can jump in if you wish to just explain the program I bought. But I'm taking the positions in the GLD and the TLT, the calls. Okay. Dean, did you?
Yeah, so you're in the pro program.
Yeah. Okay. All right. Thank you, sir. And so, Jason, after this week, I looked into my 401k, of which is I don't have a whole lot of options.
Company is it? I'll help you find the right products right now.
It is well, it's AIG, but we do not have. We just switched from Transamerica, and so we have a lot of Vanguard products in there.
You have Vanguard?
Mm-hmm. And I'm primarily holding the Admiral Prime Cap, and it's done extremely well, but it's down quite a bit right now. So we have a stable fund. So that comprises well, as of 2 weeks ago, it was a little over 100,000, and then I have 30,000 in 27,000 in cash with TD Ameritrade. So I'm kind of
sure. So let's go through your different accounts and discuss how we'd follow them. And I think a lot of people are in the exact same spot.
Okay.
Would you prefer talking about the 401k first or the cash account first?
Let's talk about the 401k.
Okay. So now in the 401k, you want to follow the pro program with your total capital, correct?
Well, I'd like to, but I'm a little skittish. I don't want to like jump in, you know.
So, okay, well, let me rephrase.
Okay.
A lot of people come to me and they have maybe 3 accounts.
Mm-hmm.
And so they're trying to follow the full system in each account individually. But when they take a step back, they realize, wait, I have XYZ assets and they're just in different logins.
Right.
So if you think of it in that perspective,
you're saying it's the total portfolio that we should be looking and focused on.
Yeah, that makes make your life a lot easier.
Okay.
So as you know, in the pro program, we have a large cash position, essentially half of our cash, half our money's in cash. We have 40% in the 30-year US Treasury, which is the TLT ETF. And we have a 10% position in gold miners currently. So you're saying you have a lot more capital in the 401k than you currently do in your cash account.
Right.
Now,
cash account. Go ahead.
Okay, so that's question one. Question two is we have to think about, are you wanting to simply grow your account to cash out at a later time period? Or are you wanting to have short-term profits to spend in the real time?
Well, in the 401k, it's more of a delayed, you know, need the money maybe 7 to 8 years, 5 to 8 years. Whereas in the cash account with TD Ameritrade, it'd be nice to produce some income.
Perfect. So with that analysis, I would say it's best to follow the option trades in your cash account.
Okay.
And then to use the most similar products you can find to our ETFs in your 401k. And that'll allow you to hold those for a longer period of time and get the lower tax rate. And then to have the short-term gains in your cash account, which you won't be penalized beyond your tax rate.
Okay.
So I would say, okay, I have a grand total of, let's say, 300, well,
Call it 100,000.
okay, let's say we had a grand total of 100,000. Your cash account at 30 is very close to what we would have designated for the SPY.
Mm-hmm.
So I would use that to follow the Monday, Wednesday, Friday trade alerts, your cash account.
Yes.
And then I would follow the Thursday trade alerts with my 401k.
Okay. Awesome.
And I think that'll make your life much easier when you think of your total assets as one account instead of a bunch of smaller accounts.
Yeah.
So does that make sense? Now let's see what makes, we need to find which one. We don't want corporate bonds. Corporations are going to be going bankrupt left or right. So we're really interested in finding the Vanguard 30-year Treasury product. Does anybody happen to know, Karen, do you happen to know what that product is?
No, unfortunately, I'm, kind of restricted in my husband's 401k. I wish I had that flexibility that this guy has. This is,
now, are you allowed to do the ETFs or you have to do the mutual funds?
Yeah, just mutual funds.
Okay. Well, yeah, so I would call him up and ask him which mutual fund you have available that is targeting the 30-year US Treasury product.
30 US Treasury. Okay.
And that'll be your core position in your 401k for the time period that we're entering right now.
Okay.
Okay.
Mm-hmm. Hey, that makes
life a lot easier. We had a client with 5 accounts and he was trying to do the whole system individually on 5 accounts. So he's having to go into 5 accounts every day. It's just complete chaos. And once we said, hey, well, why don't you use this one for this trade and this one for the other trade?
All right. So I need to be tuned in on Thursday for those alerts, and then Monday, Wednesday, Friday for the pro position using my cash account. And right now I'm holding, last week I bought 4 TLTs and I sold one on Friday. I sold one at the high 182 on Monday, and I'm holding still 2, but those were in paper. And then this week, after becoming a paid subscriber, I bought the GLD, and today I bought the TLT. Did I do the right?
I would essentially say I have one account with the total value, and use your cash account for the Monday, Wednesday, Friday trades.
Yes.
And then use your 401k for the Thursday trades. Yep. Okay. Perfect.
So, but those 2 trades that I did for real in my real account are correct. Based on your
our account, we currently have the following open positions. I can just pull that up real easy.
Again, I realize the line between advice and the Wall Street, this is what we're doing scenario you described.
Yeah, so I can say what I'm doing, and then
I'm not asking for advice, right? I'm
sure, but I can help you think the logic through, so that's perfectly fine. So yeah, here's our open positions currently.
Right. Okay. So the 3.9 GLD, I own that, and I own the TLT today. Yeah, good deal.
Very good.
Nice.
And yeah, I would not go back in time and try to get the
Uh,
old trades because we're so
absolutely.
much above that right now.
Absolutely.
Great question, Mike. I love it.
Hey,
All right.
Jason.
Hey, Gary, how's it going?
Hey, it's going great. I just heard this guy, and doesn't you really need to know how many of the calls he bought to find out if he's got the right amount of capital allocated to those positions?
That's
He's
true.
got
Yeah.
the GLD and he's got the TLT, and I heard him say he bought 4. And if he's
Well, that was last week, and
I
that was just kicking the tires. Okay. So this week, the fact that I'm in my live account, I'm just going to buy 1. I'm going to follow the rules.
Okay,
Okay.
that's smart right now.
Okay. Does that help you?
Yep, you
Yeah,
guys
Mike,
are
Gary?
both on the same page. That was a
yeah, I
good
Okay.
didn't. I'm all right. I just thought you might not have purchased the right amount because you said you had bought 4 last, when you were paper trading.
Right.
You came on and I did it live and bought 4. With the size of account you got,
No, no.
Very good attention to detail, Gary. That slipped by.
Yeah.
So thanks for
I
catching that.
love the community
Yeah.
here. It's
All
so
right.
good.
Yeah, great, Gary. Great follow up. No, it was just 1 of each.
Okay, good.
Thank you.
I think
Awesome.
you're gonna be pleased with this service. I've been with them a while. They're good.
Well, excellent.
Gary's good at picking up the details, man. I miss anything, I get an email right away.
I love it. I love a good community.
Let's see if Oscar's on. I always like to. We got to be careful about. I think Oscar had to hop off. Oscar's an administrator of South Florida hospitals, so he's got a pretty good idea of what's happening. And for the last few weeks, he's saying, I hear what you're saying, I just don't see it yet. But in the last week, I can tell you, he's told me privately that my suspicions are beginning to become a reality. Let's go ahead with Chopra. Hey, Josh.
Hey, how you doing, Dean?
This is Jason here. How's it going, Josh?
Oh, hey, Jason, how you doing?
Very well.
Good. I have a couple questions. With TLT, I wasn't sure what you were saying with the 20-year versus the 30-year.
The TLT is labeled as a 20+ year treasury. But they discontinued the 20-year treasury about, I think, 25 years ago. But they are going to reintroduce it, and they'll probably be offering some 50-year and century-year bonds to help fund this crisis. So,
Josh, great question too. I think I was kind of surprised no one else had asked that live in the webinar. So phenomenal.
Yeah, I was wondering. So TLT, I mean, like as an ETF, does it have like anything over 20 years? It has all that stuff basically. Like if it's 30 or 25, or I don't know if there's like longer than that.
let me give you guys a little mini lesson on bond market here, okay?
Yeah.
So I think the gold bugs are going to be, these gold bugs think they have their big payday in the immediate future. And I was starting to think that we were getting near a top in the TLT as well, until I really started to, you got to think, what's the problem that we have to solve and how are we going to solve it? Okay. So that's going to be critical to trying to predict the future and play the markets. So the problem is going to be a lot of companies going bankrupt and a overwhelming demand for insurance and healthcare, which is going to potentially overwhelm both healthcare insurances companies and hospital systems.
Right.
Okay, so here's the yield curve. Can you guys see this?
Mm-hmm.
Okay, so we have the bills right here in the front, the notes in the middle, and then the bonds on the long end. Now the 20-year does not exist yet. So we can go look. This is the auctions coming up. So I watch this. It's usually pretty boring and pretty repetitive. They're issuing these bills weekly, and then the notes and the bonds monthly, typically. And they're just slowly but surely increasing the debt issuance as government feels fit to blow more and more money. And currently, the cost of the deficit is just over $100 billion a month, which adds up to $1 trillion in deficit per year. Now, without a bank manipulating this market, what do you think would happen? Well, the more money you go into debt, normally a bank would want to raise your interest rates. So if your credit rating is deteriorating, the interest rate should go up because you're a less credit-worthy borrower. But that's not the way our real economic system works. In fact, it does the exact opposite. So if government needs to borrow money, the central bank lowers interest rates gradually over time to incentivize banks to buy treasuries. Okay, and then to prevent them from selling those treasuries at all costs, they're doing repo. You guys been hearing about repo?
Yeah, most definitely. Ever since '08 when they changed the laws.
Yeah, so repo is a great deal for banks because it allows them to not sell the treasuries, which they have to buy if they're a primary dealer. Now they could buy them and flip them, but if they start aggressively selling their treasury position, you're going to crash the bond market. So they can't do that. So the Fed's there to save the day. They will take the bank's treasuries, give them cash so they can not have a liquidity crisis. So currently we're only playing the 30-year bond in the TLT ETF. So if we look at the yield curve, right now the Fed's been, this is according to Jeffrey Gundlach, who has put out some pretty good stuff recently. It's been tracking the 2 years. So my expectation is the Fed will do another cut in the very near future by the end of March, if not much sooner than the end of March, and that the 2 years is going to continue going lower and lower. So yeah, this 30-year way up at 1.28, I believe, will potentially drop to the 2 year, and that the 2 year is going to go into negative rates. Okay, now why? Okay, because we have to fund much more than 16 billion a month of new debt issuance in the very near future. We're going to have to do massive fiscal spending to absorb all the bankruptcies that are unfolding. And as these rates go lower, who else is going to get in trouble? Now banks are going to get in trouble. So this is just a complete catastrophe that's unfolding. And normally, again, if you're an uncreditworthy borrower, normally interest rates should go up as you borrow more and more capital. But because of the federal fund rate really being a magnet to rates, they can artificially drive those rates lower. So the game plan for the Fed and the banks is to have the government use fiscal spending to absorb the losses of the private sector. Step one. So they got to start creating some pretty massive budget plans, which I think with the crisis, that's one thing the government's never shy to do, right? They're ready to spend money, both parties. So that's step one. Step two, this is going to dramatically increase, which in a natural world without our central banks trying to manipulate it, that would make yields spike to attract more capital. But government doesn't want to be paying high levels of interest. And the bigger problem is that all the people who bought bonds with low yields are going to be losing money on two fronts. One, the yield they're getting is too low to hold. It's less than inflation. And then two, if they were to sell it, they'd be taking a big loss. So the banks know that. So their game plan is to use fiscal spending to absorb the private sector's loss. Then they have to artificially drive the value of these bonds up so that the banks are willing to take that risk to fund the government, and not just banks here in the US, but we're talking about banks globally. So in order to incentivize that, we need them to believe that they can hold these treasuries and sell them with QE later on. So repo is sort of like a sweetheart double payday for banks, but QE will be their exit plan. So QE most likely does not come into play, at least at full throttle on the full spectrum of the treasury curve, until after the underlying problem is really contained. Because the government's going to keep borrowing money until the problem is resolved. So when you understand what's coming down the pipeline, it's most likely massive fiscal spending. Treasury auctions are going to get significantly larger, and the Fed will have to cut interest rates. Let's look at the federal fund rate chart. Okay, so this is our favorite chart. And you can see they've already begun cutting rates. They've cut rates. A lot of people think cutting interest rates means stocks go up. And there are brief times where they've cut interest rates and stocks kept going up. But in general, the use of cutting interest rates is going to benefit bond prices, US Treasury prices, and is used to help fund government spending to absorb losses in the private sector. So as soon as those losses have been absorbed, the root cause of the economic slowdown is resolved, they stop cutting rates, and then they buy up all those bonds from the banks for a nice big profit. And in doing so, that increases the amount of dollars in supply, and then you get a massive rally in stocks. Quite likely we're going to have a massive stock crash. We're going to cut rates to 0 or lower. Now think about it. We essentially misallocated $300 billion in mortgage loans in the 2008 crisis, and then repackaged those into AAA rated bond packages that were sold off as just bulletproof. And the underlying asset had huge amounts of mortgage payments being delinquent. And so that maybe was, the underlying asset was maybe 300 billion in misallocated capital, but it was leveraged up at least tenfold. So maybe $3 trillion had to be essentially absorbed into the Federal Reserve's balance sheet during that crisis. And it was really mostly centered in the United States. The crisis we're undergoing right now, I believe, will be in the tens of trillions of dollars. So they're going to have to borrow all this money through the bond market and do this for quite some time, potentially 1 to 2 years, I think now at a minimum, unless there's a miracle vaccine, which I do not think is on the table, unfortunately, anytime soon. So with that consideration, the valuation of the 30-year bond could go dramatically higher than investors expect. And so if you're counting on your gold just taking off to the moon, you very well could be a good year or two early. Now, the only good sign for gold is the dramatic increase in the repo. I'd expect that we are not going to have a big balance sheet expansion on the quantitative easing side, but rather we're going to see the expansion in the repo. So they're trying to, what I believe they'll be doing in the near future. Right now, they're just trying to slow down the stock crash. And I think insiders are loading up on these this is really the cream of the crop in debt products, is the 30-year treasury, because it's so leveraged and it has the most room to go down. And so if this catches up to the 2-year, I believe the TLT, I'll do more careful calculation, but the TLT would go up 35% from here just to catch up with the 2-year. If we see the 2-year start to head towards where the German 30-year was just last year, and again, that was just from a mediocre slowdown in China, not a complete ground halt. Wait until Q1 data starts coming in. Negative GDPs globally. So the fiasco is just getting started. Smart money is selling into every rally in the equity market. And you got to realize the big guys will never get all their money out. Stock market was valued just a month ago at $32 trillion. Well, our Fed's balance sheet's only $4.5 trillion. So you tell me how many people can actually get out at that valuation? Not many. So they're going to have to hold the bulk of their stocks and sell what they can. And I believe they are, smart money is loading into all of these treasury products, which is being held hostage now. It's about $800 billion outstanding currently in the product we're laser targeting right here.
Yeah, I got some more questions.
Go for it.
Yeah. Okay. So, okay, with the rate cut, I know the FOMC meeting is scheduled on the 17th or the 18th, and I believe that the market assumes that the Fed's going to cut the rate by 50 to 75 basis points. And I'm wondering, like, based on, like the market, like the market pricing things in, wouldn't they price like TLT in for like a 50 to 75 point rate cut? And if so, if he doesn't do a 75 point rate cut, wouldn't TLT then, or wouldn't TLT essentially then go down at that point? That's one question. And then with the repos, the Fed.
Let's do one question at a time, okay?
Yeah, definitely.
Okay, so the trend has been that the Fed's kind of trailing the 2-year.
Mm-hmm.
So I'd actually expect probably more than a 50 basis point rate cut coming up.
Yeah.
But
yeah,
at least at a minimum. Yeah. So I think if you follow the 2-year, that'll give you an indication of where that's headed.
Mm-hmm.
Now, yeah, if they don't cut rates, holy shit, America's in deep trouble.
Right.
So I'd be highly shocked if they did that. But that's one way that we stock market, bond market would collapse at the same time if that happened. So that does seem relatively unlikely. But yeah, I think what we're going to see next is the same thing you saw in Italy. They started off just quarantining small little areas. And then as soon as there was enough panic in the public, they had no choice but to lock down the whole country. But the same thing rolled out in South Korea, the same thing rolled out in Hong Kong, the same thing rolled out in China. So unless you're just completely oblivious to what's happening around the world, you can anticipate what's going to occur here next, which unfortunately most Americans I talk to are completely oblivious. They just don't think this would ever happen to them. But yet it's happening quickly everywhere. Okay, so that's the first question. Yeah, if they don't cut rates, TLT could go down. Not necessarily. So the bond markets try to predict what the Fed will do before it happens.
Right.
And so the government has to bail out all these companies, absorb the loss, and they have to fund it. They have to take those resources from somewhere. It's going to come out of the stock market. So there you go. Okay, what's your repo question?
Yeah, thank you for that. I appreciate it. It makes a lot more sense. Yeah, with the repo, I was looking back at it, and I saw that, so in January, the Fed announced that he was going to cut down the size of the repo operations, and I believe February 13th, he cut down the size of one of the types of repos, and I believe that when I was reading something, and it was saying that like when the Fed started cutting the repo operations, that's basically when the market kept, getting these quick corrections and drops down, and it was like random. It was like, it wasn't even it was a post by some guy's post where he was saying um that he believed that it had something to do with the repo operations, like basically lowering the repos, and then the banks not having the extra cash that's needed so that they can give the lending out. And another question I had is with the repos. I thought that the technical difference between quantitative easing and repos is that repos are supposed to be short term, like 3 to 5 year or something like that, and then like technical QE would be like 10 years and longer, or 20 years and longer, something like that.
No. So, okay, let's just answer these questions to start. So first of all, let's just define the difference between repo and QE. Good question. So in quantitative easing, I'm actually selling my asset to the Fed, which is the Treasury, and then I'm out of that asset. Okay, so that would be essentially what happens when the bank took the risk to loan the government money by buying the Treasury. The reward, once the crisis is over, is the Fed will come in and do quantitative easing to take those treasuries out of the bank's hand and reward them for taking that risk by giving them a profit, by exiting. Okay, so that's how we keep the bond market from imploding on itself and rewarding the investors who lent the government money. Okay, so that's QE. QE will most likely happen in full force on the full spectrum of the Treasury curve after the underlying problem is resolved. Okay, so that's when you really want to get very bullish on gold, and especially gold miners. Okay, so if we thought that this was a quick fix and a quick problem to resolve, then you could expect we get to rates low and then turn on QE and cash out all these bonds. I don't think this is a quick fix. So, okay, so that's first difference is QE is actually exiting the trade completely and getting the reward delivered to the bank or to the investor. Okay, so repo is designed to allow the bank to hold their position for a longer time period and not become illiquid. So if they didn't have repo and the bank did not have any capital to loan, the financial system freezes. So repo's indicative of economic trouble. That means our banks are out of cash and there's demands to borrow from the private sector. So let's just look at the growth of the repo over the last, this is just in the last 14 days, or I guess February, what was it? It was a leap year, right? So we had February 29th, anyway. So we're looking at repo back on February 27th. And again, so the repo is designed to allow the bank to hold their position and not be forced into liquidating it. And I believe repo is going to get outrageously large in the near future. And if it gets too large, they may have to do very light QE to trim down the size of the repo. So we're probably going to see a crazy what they don't do yet at the Fed is buy stocks. We've seen every major country start to change their legal system to prevent short selling and starting to try to protect their stock markets. in the way that Japan has, which obviously didn't work out so well. And now they own 80% of their own stock market. So here's February 27th. The banks submitted $38 billion in overnight loan requests where they traded in treasuries, which normally would have had to have been sold. So if normally, without this intervention from the Fed with repo markets, the bond market would have spiked its yield because all this money would have to be sold so that the banks can operate, not create a financial freeze. Let's just watch this go up. It's just, and you're right. They were telling us, oh, the coast is clear. We got a trade deal with China. Lovely. We're going to start reducing. Now, why wouldn't they want to just have unlimited repo? That's a good question you should ask yourself. Well, what's America's greatest asset? It's not the stock market. It's not the bond market. It's really the power of the dollar. It's the dollar.
Oh,
Yeah, the dollar is really critical to our sovereignty. So they don't want to do QE and they don't want to do repo unless they've really screwed up, because that weakens the dollar, which is our greatest asset. And
King dollar. When
yeah,
you're the king, everyone wants your seat.
it's hard to keep that control over the international form of trade. Okay, so repo went from 38 billion on the overnight loan. Then they have the 14-day loan. We can see it was oversubscribed, 46 billion out of 25, also on February 27th. Then we have another 1 day, the next day, 30 billion. So it went from a little bit lower, so it's still looking pretty good. Then we have a 3-day loan for $26 billion accepted. Then we do a 1-day loan March 3rd. It's now up to 53 billion submitted and accepted. Then we go to March 3rd for the 14-day. Banks want to borrow $70 billion, only 20 billion accepted. Banks are in stress mode. Go to March 3rd, $108 billion. So you can see these are just growing astronomically. This is for the 1 day. They accept 100. We go to the next 1 day, another 110 billion approved, submitted, 100 billion approved. We get to March 5th, 72 billion submitted, only 20 billion accepted, showing stress. Let's get up to current. Let's just see what they've had to do today. You can just see they're just gradually growing it. So today we did 123 billion submitted and accepted all of it. The previous day, they requested 93 billion for the 14-day, accepted 45. So the banks are running out of cash, and in a normal world, they would have to sell those treasuries, but the Fed does not want those treasuries to be sold because the government needs to borrow a lot more money. And if everyone started freaking out and selling these treasuries that have a low yield, it would collapse the bond market. So my anticipation is this is going to grow rapidly and that we're going to start seeing some massive fiscal plans. And, you know, they approved $8 billion plan. That's a joke. It's going to have to be trillions of dollars to solve what's coming at us, unfortunately. And here's another indicator that you can watch that will give you an idea of just how bad things are getting, and realize that, you know, so this is log scale. That means the 10, 100, it's not a normal x-axis. Instead of it just going up 10, 20, 30, 40, 50, it's going up 10, 100, 1,000, 10,000, 100,000.
Yeah, I watched that. I saw it was flattening like maybe almost 2 weeks ago, and then and then it started going back up.
Yeah.
When all the new data started coming out.
So unfortunately, I think it's virtually impossible to stop the spread of this disease. Its complication rate that requires hospitalization is extremely high. So if you get those two concepts, you realize the strategy for survival is you must slow down the spread at all costs. So I think we're going to see governments forced to intravenously lock down cities or even entire states or countries. But then these people will all starve. So they have to reopen. Okay, as you reopen, you're going to see hotspots reemerge. And so I think we're going to be in a prolonged period of having to do these ridiculous quarantines and lock people down and restrict social interactions as well as economic activity in order to slow down the spread of the disease and to not melt down the healthcare system. So it's a fine balancing act. At the end of the day, you can really count on two things. One is GDP growth is going to slow down and probably go into negative territory globally. So that's one. And that two, the losses being incurred are so large that the government will have to absorb them. So they're going to have to incentivize investment into bonds, into government bonds specifically, to keep their economies alive. And so when you put that all together, how do we verify what's going to happen? Well, number one, we need to pay close attention to the government talking about their fiscal plans, which, you know, so far it started at 2 billion, then it went up to 8 billion. It's going to cost trillions. So I'd expect these auctions to get dramatically larger. And then I would expect the federal funds rate here to rapidly go down until the problem is resolved. And I think you'll see that all the central banks will work in unison to essentially force capital to go to US bonds or to all government bonds. And that's going to come at the cost of the stock market losing value. Now, how does gold play into it? Well, gold's real payday is when they actually officially, it's not necessarily from the repo, which is increasing the money supply. And the longer that remains elevated, that will have potentially positive effects on gold. But I think that all these gold bugs who are on top of this, you know, these gold bugs are always out there looking for, like Chris Martenson, I'm sure a lot of you guys listening to his daily video. All the gold, silver bugs, man, they're going wild. They think their big heydays coming. But I think that they're going to underperform a simple treasury play right now, and that they're about a year to 2 years early from the big push. So the big push will be liquidating the bonds after the trouble has been fixed and we have a permanent increase in the money supply. But right now, the government's going to have to act as a magnet to suck in all the resources possible, absorb the bankruptcies that are unfolding, stop this crisis. And then after it's resolved, that's again when we would see the repo slow down, the stress on the banks slow down, and then we see QE come in and vacuum up all these worthless bonds. And, you know, we could, so if we grew, let me pull up, let's just see how much our balance sheet grew to just deal with a tiny housing bubble where we sold houses to poor people, for heaven's sakes. I mean, that's all that happened to create the 08 crisis. So the last crisis grew our balance sheet. We went from $1 trillion to $4.5 trillion. I'm just going to ballpark. This has to go in the next 5 to 10 years to pay off all these losses. I think it's going to probably go up towards 14 trillion. because of the magnitude of this disaster. Now, is there some miracle cure that's going to suddenly fix all of this? If there is, then I would really question who was behind this and how it really unraveled. And I'm quick to change the mindset. If we really can resolve this issue and get back to a normal economy, great. But I don't think so. From my research, we are in the dark ages of vaccinations related to viruses. So maybe we can make some medicines that help sick people recover. Maybe. But what I don't think we're going to be able to do is stop the spread of this disease. And so just from that fact alone, I believe that will cost governments trillions of dollars to resolve the crisis and absorb all the losses that are about to unfold. Okay, next question. Oh, you got another question, Josh?
Yeah. Thank you, and that makes a lot of sense. Yeah, I mean, silver has been selling off since the crisis. I think because the Chinese economy, like the labor market or the average Joe in China, they where like in India, I know I'm Indian, and I know from my family and from visiting India that every Indian mother, their form of security is in gold, like gold jewelry or gold coins. Like every Indian mother I know, they always have tons of gold tucked away, and that's like their form of security. For Chinese, it's silver, and so right now during this crisis where, everybody's in China lost tons of money, already the labor market is spending their silver, they're like cashing out their silver. But and gold, it makes sense as well. Gold has been consolidating for a few years now, and it definitely looks like it's poised to go up. It makes sense that it would be going up. With the Fed, I was going to ask, what I read something about like the Fed like being out of money, or like something to that extent. Like that was one question, is if you've heard anything about like the Fed running out of cash, or having any possibility of running out of cash, if that's even possible.
Yeah, so the Fed can print as they please. So yeah, that won't happen. So yeah, the Fed has two tools. They can print and they can control rates. So gold's not performing like many would hope it is, especially gold miners and silver specifically. So I think the bigger move first is going to be, and I've been saying this for quite some time, is that first bonds get priced to perfection, then you get your gold rally, and it should be aligned with quantitative easing. I think the miscalculation investors are making, specifically gold investors, is the timeline of when we're going to enter into QE. So repo's okay for gold and silver. I think gold and silver should hold its weight, and I would suspect that even though we've seen some volatility lately, that it's not going to crash, because we can see in the repo markets, this is going to expand. And I think people will be able to see far enough into the future that results in an expansion of this balance sheet, which is really the driver of gold, is the size of our Fed's balance sheet, or the total dollars in circulation from that. So yeah, I think the big miscalculation is that people think this is going to resolve by summertime, and that we're going to rotate from rate cuts into QE. So unfortunately, I don't see any evidence that that's the case, and I expect us to be in a very prolonged bond bull market until this crisis is resolved, which I think can take no less than 12 months and more likely 24 months. So that's something that's really hard to consider when we look at all of U.S. history with the federal funds rate. Let me go to that chart. Oh, that's balance sheet, my mistake. What I was expecting, of course, was not a pandemic. But I was expecting we may be just without a pandemic, just from misallocations of capital in general, more like the dot-com bubble and the 2008 crisis, just, pure stupid loans from banks trying to get rich quick and not really thinking about the fundamentals of their investments and knowing that they'll always get bailed out. So I was thinking we would do something like the 1950, 1960 bounce, sit there, blow money, try to keep continuing the business cycle at the cost of having large zombie companies waste money until we get runaway inflation. And that we wouldn't potentially have a risk of going below zero. But when you start to grasp the sheer magnitude of what's coming down the pipeline, I am now starting to get into the camp that I think we will see negative yields on US Treasuries and potentially negative US interest rates, which they've joked about in the federal minutes, but it's all about how much capital has to be borrowed for how long to resolve the fundamental problem here. And then, okay, so then you ask yourself, well, why don't we just let the virus spread as fast as possible and be done with it? Get back to work. So sick of this coronavirus. That's, but then if you look at the numbers, you take 7 billion people and you infect just 10% of those, and then you just put 10% of those into a hospital, you have a complete meltdown. So then you realize, okay, so the strategy has to be to try to slow down the growth of the virus. Okay, so that means they're going to be walking this careful line of, hey, are we going to starve the population by quarantining them, or are we going to let them go out and work at the risk of them spreading the virus and melting down the healthcare system? So I think you're going to see that the bond market outperforms all asset classes for a long period of time with much less volatility than investors are expecting.
Got it. That makes sense. Okay, thank you. Yeah, a couple more questions. Number one, okay, so I know, like with SPY, like people are going to invest in the treasury notes as like a rush to safety. And when I look at the SPY on what's on like the weekly chart, it's it's still oversold. It's not up at 98% or anything, but it's still it's about 90%. And what, or no, I'm sorry, it's no, it's not, I'm sorry.
You're looking for prediction on SPY?
Yeah. So what I was going to ask was, like, what about the dead cat bounce? Like, wouldn't you think that it's going to have some sort of like a dead cat bounce at some
I was
point?
trying to catch it early on before the crisis really unfolded, and I missed it by a day. So here's the thing you got to realize. If you're going to invest in a stock market that is crashing, you better do it with a put option below it. So we call that the married put. Otherwise, why take the risk of trying to catch a little bounce in a falling stock market when you can make a almost risk-free bet on the bond market? That's a question you should really ask yourself. But yeah, the VIX is so high right now that the cost to it's kind of like trying to buy insurance on your house after it's on fire. Okay, it's not worth it. Let the thing burn down. So that's really where we're at in the stock market. The stock market's on fire. As long as the VIX is over 40, you can just assume the stock market is on fire. So you can't safely buy the SPY and buy the proper insurance to own that asset right now. So I would just say, why make your life, you know, if our goal is to make safe profits with low volatility, it's easier to predict the bond market. Okay, now what could save the stock market? I don't think any technical level is going to do it. I don't think any RSI reading is going to do it. I don't think any fear and greed chart's going to do it. I don't think any Fibonacci level is going to do it.
No, I think an announcement of a vaccine would probably do it.
Yeah, and I don't think there's going to be any vaccine. So yeah, the only thing I see doing this would be if the Federal Reserve changed their rule book, which I believe would have to be approved by our government to allow them to buy ETFs and stocks. Right now, they can only manipulate the bond market. And so smart money, they realize this, you know, they're selling that. These guys have so much money in the stock market, they can't sell it all. There's not enough money in China to sell all of the US stock market. Our federal balance sheet I just showed you is at 4.5 trillion. Well, the stock market's worth 32 trillion, at least it was a few weeks ago. So you got to realize less than 10% of the population can sell at that premium price before all the money in the entire Fed's balance sheet would be replaced. So very few people can get out of the stock market. And what I see happening is they're selling stocks on the rallies, using the media to try to keep people buying it as long as they can, as cruel as that sounds. And they're buying up these assets they know are going to be protected by the central bank and the government, which is the bonds. So yeah, we saw, you know, we're sitting on, I know it doesn't feel good. We got a lot of people who are up more than they've probably ever been up in their life, from this little candlestick up to 180. And now they're still up, but they're not up as much. And the emails that poured in upset about this, all I have to say to you is my expectation is this is going to go. Unless there's nothing short of a miracle, this is going to go parabolic. And that's not a good thing. I mean, it may be a good thing for us because we can decipher what's going on, but that's not good for America.
What do you think if like as far as the vaccine, like I know with SARS, about a decade ago, I think it took them like
they made
18
one
months.
vaccine and they tested it on mice and it killed the mice. Okay,
I
so
thought
two
they-
decades later, we have not solved SARS.
How is SARS contained?
So SARS, luckily, so what it appears we have here is a combination of 3 different characteristics of 3 different diseases. Okay, so the flu is notorious for its infection rate and being airborne. Okay, but luckily its complication rate is remote. It's very tiny. So we can go have flu and, you know, how many times have all of us on this call had the flu? Flu's been around for 100 years. They make new vaccines for it every year. It doesn't stop the flu from continuing to live on. Okay, so that's one. Okay, so it does seem quite evident at this point that the COVID-19 is airborne. So it has this characteristic that's similar to the flu in terms of its ability to infect people from a far distance just by being breathed into the air. Okay, so there's a case study that's being highly investigated right now where someone in a bus was the only person who was sick and transmitted it to someone in the back of the bus. So there's a lot of these smaller, and again, the government's trying to hide everything you could possibly find that's alarming about this. But it does appear that this particular disease is airborne. Okay, so that's one. Two, it's spreading without having symptoms. So SARS was highly deadly, but it only spread once you're already sick. And the incubation period was much quicker. So you would get it, become sick, and then they could quarantine it. So the way we stopped SARS was by quarantining it. We were able to identify who had it and get them out of the population and just put it into these level 4 biolabs. Okay, so what I understand is that this virus, this disease that we're now dealing with, is airborne. The incubation period, the healthier you are, the longer the incubation period. So healthy people are picking up this disease, letting it grow in their bodies for weeks, spreading it to everyone they come in contact with. They have no fever, no cough, so they have no clue they're spreading the disease. So you can't stop the spread of this. And it does look like the outside shell of the virus is certainly from the SARS family. So the mechanism of how it's latching onto the cells in your throat and lung does appear to be very, and I'm not a virologist. This is my best understanding of this. Okay. The RNA, little squiggly worm inside the virus, appears to be something similar to the HIV virus. And it also has these properties that it spreads in the air. So the combination is absolutely catastrophic. So now you can understand that governments just don't know what to do. If they tell everybody what's really going on, the economy freezes, we all starve, and potentially a lot of people rush to the hospital and collapse the hospital system overnight. If they lie to the public, we can keep the economy going, but the virus will spread quicker. So why is Trump telling us that it's, nothing to worry about? I don't know. My expectation is we're going to have the same fate as all the other countries, and it won't be long until we're in lockdowns. I think LA, probably Washington State, and New York will be the first 3 areas that are going to undergo some pretty serious restrictions. And that's when I think we'll get a really nice pop in our TLT position.
Oh yeah, Washington just did about an hour ago. They banned gatherings of 250 people or more.
Yeah, I'd expect a lot more of that. So if we do start looking at like technical analysis to try to, at this point, I think this thing is just going to go parabolic.
Where was that ban initiated?
Washington State, they just banned gatherings of 250 people or more.
Okay.
Yeah, you know what? This is comical. I don't know how many. I've been talking to doctors here in my state and giving them a hard time. It's like, you guys don't know what the fuck is going on, do you? We're not being blocked on tests. Here's where I live. We're the only state in the country that has no reported cases.
We have 3 reported now, Jay.
Oh, we do?
Man, dude, I live pretty
God.
close to all of it. I live in San Francisco, which is, yeah, we're fucked. We're screwed.
Yeah, I was telling the doctor, I was like, well, are they still, trying to get her to get upset? I was like, are they allowing you to do tests? She says, oh, they're never blocking tests. Anyone who's really needs a test is getting a test. I was like, so tell me this, have you tested yourself? Oh, well, I don't think I have it. Well, what the? First thing that needs to happen is they need to go test all of the medical staff and get them in some bunny suits. Because what's going to happen when our entire, you go to look at Italy, a huge percentage of the medical staff is now infected. So I'm trying to figure out why our government and health officials are just lying out their ass. I can give them the excuse for so long And the only excuse I can give them is they're trying to prepare something to protect us and give us a little time. But if we don't see the tune change rapidly at the highest level, and I'm talking Mr. Trump, then we got to really ask ourselves what the heck is going on here. And also, I guess I was seeing a lot of people they combined Taiwan with China. It's just so corrupt. This is all so corrupt. You can't trust any of this. A lot of people are speculating that China wants to start taking over the surrounding territories. And yeah, they just combined China and Taiwan. Anyway. We'll save the conspiracies for Thursday. I have studied every conspiracy out there. What I believe, I haven't seen anyone lay out the exact concept I have. It doesn't necessarily matter in the short term in terms of where I think markets are headed. In the long term, I do believe it will be critical to figure out, what's the trail, what's the criminal trail of how this all rolled out? Why were the testing kits incorrect? So they sent out fake test kits. I'm gonna guess on purpose to slow this down. One, why is the data coming through total lies? Why is the media lying to us? Why is our administration lying to us? Why are the Dr. Fauci, Cesar, all these guys, everybody's lying to us about what's really going on. So that's how I was able to predict the stock market crash and position us to make money when everyone's getting killed. And for quite some time, everybody thought it was absolutely batshit crazy. And now the world's slowly waking up here. So that's kind of the long and skinny of it. Let's go ahead and give some other people some chances. Those are really good questions, Josh. I'll come back to you in a little bit. Let's see what other questions we have out there. Great questions today from Josh. Go ahead and hit your hand raising button if you'd like to ask a question. Gary, go ahead.
Hey, Jason. I got in a little late today. You were talking about getting into another TLT position 163 for April.
Yeah, let me pull up the trade doc.
Yeah, I got in it at 7. I didn't know. I wasn't quite sure. You said you mentioned something else, the GLD. Are you doing another GLD call?
No, so it says stay in cash, hold all TLT calls, all GLD calls, and buy the new TLT call. So
Okay.
I'm not recommending going back in time, but here's what your course of action was today.
Yeah, that's what I saw. I was just double checking to make sure I didn't miss something. So I did buy into the TLT another position, but.
Okay, great. Well, good job. And you can see that same at the money call options getting dramatically more expensive the faster this moves.
I was going to buy 2 and I didn't, and I'm just kind of sorry I didn't. It's already up to 770, 895 or something. It's driving up quick.
Yeah, I think this, it's a very, very confusing time period for investors. You get your trustworthy people you voted into office lying to your face. You get Warren Buffett telling you everything's okay. And then we sit here and watch stocks crash and a epidemic roll out. And we have to ask ourselves what's really going on. So it's a sad month for America. I don't know what exactly is going on. My inclination is that we are in a battle and we're losing this battle. Against who? That
China?
really,
I don't know.
yeah, maybe China, but the thing you got to understand about the history of China is that they have been buying out politicians for decades. So we may have some traitors here in America as well.
They also own a lot of, or Hollywood loves them, you know, because of the movie industry in China.
Yeah, so I'll go through all the possible conspiracy avenues, good and bad, accidental and evil on Thursdays. But the bottom line is we can look at the tape. This is not healthy stock market. It's up on fire. And we're probably on the verge of lockdowns in LA, Washington, and New York City, and maybe in parts of Florida. So my expectation is the death count starts to, I would just follow what's happening in Italy very closely and expect what you're seeing there will be the fate of America delayed several weeks. And also that the longer our administration waits to ring the alarm bell, the worse the initial impact will be, unfortunately, in terms of human life. Yeah. Okay, thanks, Jeff, for sharing that with Randy. Let me look at these comments coming in. Jeff says they've delayed the updates. Yeah. Mark says, are you in the camp that once things normalize, be a buying opportunity of lifetime to own stocks, especially dividend stocks? I don't know about dividend stocks, but yeah, I think we're going to see a bear market for equities for 1 to 2 years at a minimum. So, and that it will be greater than 50% crash. You just got to compare apples to apples here. Well, this crisis, in terms of the dollar amount it's going to cost, has got to be 10 times that of the 2008 crisis and the dot-com bubble, maybe 100 times. So if you think that a 50% correction is the maximum that stocks will go down, I'd say, think again. The stocks will continue to go down until the underlying problem is resolved. And I think that for humanity to survive, we have to slow down the crisis as slow as possible through lockdowns, which results in crashing GDP levels. So unless the Fed changes the rule book and just buys the entire stock market, but what cost would that? Well, then you lose the value of the dollar. So at the end of the day, I do think this is the end goal would be to destroy the dollar. Because it's either we either ruin the dollar, we ruin the bond market, or we ruin the stock market. But you can't save them all, not at the same time. So probably they're going to let the stock market go, raise capital at the government level to resolve the problem, because this is too large of a problem for private sector to solve. So they have to push all the resources possible into the bond market, and then use the government to bail out companies who are in trouble, keep them alive, not necessarily profitable, just alive, and try to take care of this, what I believe is probably a biotech.
Hey, Jason, how do you think that, so you have talked about that sort of three-way puzzle before. So how does real estate fit into that? Because if one of those three bond stocks or currency is going to take a hit, what How does the real estate play in that, you think?
I'm not an expert at real estate market, but if rates are going lower and the money supply is increasing, I look at that almost like a commodity play. So I think real estate's not going to crash. I don't know if it'll go up, but I don't think it's going to crash. Not too much.
Unless we have a big recession or depression, then it's almost
Yeah, I
certain.
guess if you're right, if the incomes drop. So I see a massive fiscal plan coming very soon, which could be helicopter money directly to people. Think of Bush during the 2008 crisis, giving everybody, what was it, $2,000? So I could see that happening. So yeah, I'll do a little more looking into, but yeah, with rates going lower, there might be a short-term shock, but again, we can't afford to be in lockdown for very long. Otherwise we all starve. So it's going to be this fine balance of going into lockdowns, slowing down the spread, dealing with it, quarantining people, and then going back to work. And then we see a little wildfire starting, quarantining that area. So yeah, I'm not super educated on how this, but from just a broad look, with rates going super low, I think your real estate's not going to get too hammered.
Yeah, I just think it might be a real estate play at the end of all this, like, commercial real estate or something like that, as the economy gets through this and then begins to recover. So I think it's at the tail end of
commercial real estate might be in trouble. That's a good point.
Yeah.
Yeah, I'd have to do a lot more research on the supply demand of all the real estate and property out there, but
I think we have plenty of time before that opportunity comes up.
yeah.
How do you think this will affect the Canadian market? Because they don't seem to be worried. Here in Canada, nobody seems to be worrying. They're just going about their business and saying, oh, it's just the flu.
Yeah, well, they won't be saying that when people are dying.
Healthcare.
Oh, maybe. But no, but it's a good health care. Thank God I have it. I mean, I am so
I was talking good about it. I'm saying it's a good thing.
Yeah. The thing is that our prime minister and the provincial the premier, they were in a crowd with people who were traveling, and somebody had the virus, and they're just going about their business, having conferences and being among people, including doctors they're saying, oh, we're just following protocol and washing our hands. And I'm thinking, but it's a viral infection. So you breathe on people. And as you were saying, if somebody is healthy, they can carry around this thing for a long time.
I think all stock markets will crash. There'll be a handful of private companies that benefit, but probably you got to wait till they've already crashed and then start actually getting the money from the government.
Oh, okay.
So I think, no stock is safe in the short term, regardless of how they're positioned to benefit from this. After the fiscal spending is occurring, I think that we will see some companies just barely stay alive and not be a good investment, but some companies stand to really benefit from what's coming down.
So you're talking about a depression then?
Yes.
Oh, Jesus. So, okay. Oh my God. I better go out and buy my rice.
Yeah. Go, you don't want to do that when it's too late.
Yeah.
So what changes this? Let's say they suddenly have a vaccine that really prevents it. That could resolve this pretty quickly. Now, treatment for the disease is not going to stop the financial collapse. So it doesn't matter if we get a bunch of sick people and we can give them something that just helps them deal with it. That's still not really what we need. We need a true vaccine. So we were not able to create a vaccine for SARS.
No.
So I'm skeptical, and that's 17 years ago. So I'm skeptical. Now, maybe they have a top secret, you could speculate that someone sinister created this bioweapon, created the vaccine, unleashed it on the world, waits for it to get to a tipping point, and then suddenly comes in with this drug and makes trillions of dollars selling it worldwide.
Okay, so that was my theory, and everybody thinks I'm crazy.
Yeah, you can come up with, you could say maybe they're just trying to, we know they've been experimenting with bioweapons for decades. We know that's a fact. U.S. especially. Okay, especially the United States. Far more of this than anyone else in the world.
Yeah, I think
so maybe it was just a complete accident.
Yeah. Yeah.
If it's a complete accident and there's no vaccine for 14 months, we've got a 14-month really rough period coming up. Now, is heat going to kill it? That's what a lot of people are hoping, at least maybe a little bit of a reprieve in the summertime.
No, because in Iran, it's hot and they had 80 something degrees and it was running rampant in Iran.
Well, in Iran, it actually does get cold at night. So I would focus on Singapore. Singapore, one of the most advanced civilizations on the planet, very easily for them to isolate themselves, super rich, and it never drops below 80.
Yeah, well, apparently it's in Africa as well.
Yeah. Well, I think it wouldn't be too difficult for them to take some specimens of the virus and see how heat affects it. Unfortunately, I haven't heard too much good news, but yeah, Singapore would be a good, if they can't keep this under control, then who can? And again, if we do this measurements of going into, you just got to realize the flu's been around for 100 years and continues mutating. So this probably is going to be with us for the rest of the time. Now, can we quarantine it? Probably not, because it spreads without symptom.
Right.
So that's what's been keeping me up at night, is realizing that this is a virus that you can't stop, and they're lying to us about how deadly it is.
I think so too.
I'm
on this
smart money's figuring that out.
Yeah, the Discord app is showing that they're saying kids don't get it, but there's videos of them putting in China little kids in body bags, and they're keeping it a secret. And they're using.
I saw that.
Yeah, you saw that? So they're saying little kids don't get it, but that's not true. Yeah, that's sad.
Yeah, the Spanish flu was actually specifically more dangerous for 20 to 30-year-olds, which was interesting. So, yeah.
I don't know. Well,
they're definitely not telling it. We don't have a whole lot of data. We have a lot of anecdotal case studies from certain regions. But, stock market is where the smartest money resides, with the most intelligence. And they are without doubt telling you trouble ahead. So that's really verifying what we assumed for quite some time. Let's see. I'm going to go ahead and go through our programs, and I'll go back to Q&A just to review what we offer to investors. Besides nightmares, just kidding. Our product's supposed to be sleep like a baby at night with your money, but unfortunately, right now the tune of it's not so. It's not ponies and rainbows right now, is it? Okay, so we have on the option page, and we can post a link to it, really 4 different services we offer. The first offer is good for portfolios below a value of 30,000 who do not want to trade options. And in fact, you probably just don't want to touch it much at all. Perhaps you don't mind listening to these replays. You may not even want to join us live. This program protects your capital with very, very, very few changes, and has performed well relative to the stock market clearly this year. Let's see, we're up 2% right now, and we have you half in cash. This program only updates you on Monday. So you get the Monday webinar, so you can come talk to me and ask your questions, and you'll get a weekly update via email. So tell you exactly how I would allocate your capital with a buy and hold strategy without utilizing the options market. And again, this barely touches its assets. So dramatically outperforming the market this year with very little work. And again, that's a lot of our clients are using kind of extra cash or 401ks or IRAs, some of those college plans, they're using this just for smaller amounts of capital. The next program we offer is the basic program, which normally trades the SPY. We built this whole product because of how much we love the S&P 500, the SPY ETF specifically, its exposure to the top 504 companies in America, plus 3 option contracts a week. So right now, unfortunately, we are just staying away from a disaster unfolding and putting out small option trades with very little capital. And it's performing very nicely. That result that you would have is right here. Now, this was up as much as 15% on Monday. So we're dealing with some extreme moves in the market. Not only are people having to liquidate their entire portfolio because they're potentially at over 100% loss or nearing that point of no return. So they're liquidating everything. Not only do we have central banks literally trying to trick investors into buying the stock market in collaboration with your talking heads at the highest level, from Trump to Kudlow to the frickin' health Azar telling us stock market's great buy. What the hell is he talking about the stock market for? All the way down to CNBC. So the media, the whole industry is trying to keep you in stocks. Even Warren Buffett, someone I love, telling you to buy at the top and hold. So my expectation is we beat the return we had on Monday by the end of March. For those of you who've been nervous, I know a lot of you guys have been writing in nervous about these positions. Again, I warned you to expect drawdown and market manipulation. But the overwhelming force is in our favor. So patience is key here, and not taking too much risk and following the program. But regardless, this product is up 2.7 currently, and investors are just getting clobbered this year. But I want to point out, I'm not some sort of bearish trader. Even in a very bullish stock market, I was able to produce 14% return in this portfolio, exclusively trading the SPY with only 3 periods of drawdown. Each of those periods were less than 1%. So show me any track record that has anywhere near these returns with maximum drawdown below even 2%. I don't think you can find it. So again, our goal is to deliver safe returns with low risk and to protect capital. So this has done a phenomenal job at that, but it's not nearly as safe and smart as our pro system. So this system trades Monday, Wednesday, Friday. It's designed for investors with between $30,000 and $75,000 in capital, which gives you either 100 to 200 shares of the SPY to follow our Monday, Wednesday, Friday trades. And right now we're in this oddball time period where we're simply staying in cash, avoiding risk, and buying relatively inexpensive call options to derive profit. And again, I believe that you'll do very well in this product if you are in that $30,000 to $75,000 range. And if you have over $75,000 in capital, really the pro program is far, far better. And that's because we do an equity bond portfolio with some exposure to emerging markets and some exposure to precious metals. So you're trading like a real professional hedge fund manager who understands the relationship between the stock and bond market. This track record is really something I'm very proud of. We've literally had 1 losing month and 1 flat month. The largest loss was 1%, and the flat month was obviously flat. And so this has had to survive the December crash, volatility from the tariffs and trade war, which I would argue is probably related to what's unfolding now, China not wanting to give up its competitive advantage. And now in this year, where we are entering bear market territory, you can see we're greatly outperforming other investors, up 4.6. So again, this program is the same on Monday, Wednesday, Friday as our basic program with the same combined group. Thursday is when we invest half your capital in the bond and precious metals market. And so you're going to see, guys, if I'm correct, and this does go parabolic, the cost of call options is going to get astronomical, and it's going to become more important to own the underlying ETF, and that the opportunity to buy these call options is going to become more and more difficult. So in our basic program, you've been really having some extremely great results, being able to take advantage of being one of the first investors to predict what's unfolding. But I do believe the pro system is going to have the unfair advantage the higher this goes, because option pricing is, as you've seen, is already doubled for the same at the money strike. It's just a week ago. So the more this screams up, the more underwriters are going to charge for that call option. So again, that is our pro system. Now we do have a bonus when you upgrade to any package. We want to improve your education. So we're going to give you 30 days free into our boot camp. That's where you, as you've noticed, I'm not too big on technical analysis. A lot of people come to us that already have great technical analysis, but all the technical analysis in the world doesn't help if you don't predict direction, right? So what I'm going to teach you how to do is predict direction, understand the fundamentals of how the two markets work, the stock and bond market, and then how to control risk and use the option market to your advantage. We also cover how to trade futures and currencies as a bonus as well, where there's potentially some opportunities. This is normally a $10,000 one-time fee. This program meets every Thursday after the pro webinar. So an hour later, we take an hour break, and then that webinar unfolds. On Tuesdays, I provide an extra email to you where I telling you everything I'm thinking about our trading strategy. Sometimes it has bonus trade alerts where we go for extreme returns with low capital risk. And also I provide extra content. So yesterday, for example, I had a 2-page essay on really detailing what I think has to happen to resolve the problem America's and all of the globe is going to have to deal with, and why that may get gold investors completely off on timing and miss out on the big move that's about to occur. And then I provide you with the top 5 YouTube channels to subscribe to know exactly what's going on in the coronavirus, which is critical right now, is to focus really on 3 things: government fiscal plans, 2, the coronavirus and treatments for it and its spread and risks. So without understanding how deadly this was and how unstoppable it was, I would have never made these predictions. So it's sometimes you have to start learning about things you never would have guessed to do a good job at predicting markets. And then 3, figuring out what the Fed's going to do before they do it. So that really involves reading their Fed minutes, listening to all their speeches, and even more importantly, watching what other central banks do, because they do work in coordination and in unison to keep these financial markets up. So that's a bonus that you do get when you join any one of these 3 programs for 30 days free. And again, if you are trading less than 30,000, I would start off in option 1 and jump into the education system. You immediately get access to all the previous modules. If you're trading between 30 and 75K, this is a great spot for you. We're going to take great care of you, and it's a good starting point. But if you do have a larger portfolio, which I would say about 90% of our clients end up having, they almost all end up immediately in this program, because it is a much safer system because you're not just trading a single asset. Randy 2 says, can I get option 2 and a 30-day bonus in the boot camp? Yes, sir. Absolutely. So you can click the link right there right now and order, and we will award you the 30-day bonus in the boot camp. Absolutely, Randy. So that link is that options link that just came through. Jeff says the video from China and the body bags was not from COVID. It was from carbon monoxide poisoning. That's it. So Jeff, how do you know that? I saw that video long ago as well. I didn't share it because I didn't know exactly. There's the option link in the chat box if anybody does want to go pick up their membership. Mark says we're 3 months away from a total supply chain breakdown. Get toilet paper. Yeah, I have a video of this Australian. He comes home and his door's open. All his TVs and guitars are fine, but they had raided his toilet paper. Saras says, I've sold SPY in emerging markets. Should I use the funds to buy TLT? No, I'm not recommending a 100% TLT position, Saras. So we have 40% in the TLT, and we basically have, for every 100 shares of the SPY you used to have, which would be $30,000 in capital, you should have 200 TLT and 200 GDX. And everything else is in cash. So I don't want to overexpose our investors to the TLT. I think a 40% position is very aggressive, and we can make plenty of money with that allocation size. Four new messages. Oh yeah, I set up the Discord chat actually right when this first was breaking, then I handed it over. Someone's asking about the boot camp, MF Core. Is there a monthly option? We don't have a monthly op. Which package were you interested in, MF Core 2065? We can get you, oh, you want to start with the boot camp without an advisory? We could certainly get you a payment plan to get the boot camp. And actually, if you do buy the boot camp direct, we can throw in some free time in the advisory because you're starting off at our highest price point. So a lot of people do actually do that who feel like they need education before they jump into this. So I'll have Dean get a hold of you to find the right package for you. DD says AIG did a business continuity test Sunday with all employees logging on from home at the same time. Yeah. Well, Harvard sent everybody home. Houston livestock show and rodeo closed. Yeah, halfway through. So Ford is going to do the same test, Jeff says. DD says, loves the bond trading, but it's too fast, too many terms. Is there a remedial course you know of? Yeah, the bond market's crazy, isn't it? It's all upside down, opposite. This whole, because we have, you could call it socialism for banks is what we really have in this world instead of capitalism for banks. They've taken over the governments, created their own rules, and control the money supply. So everything's upside down. Now, Didi, are you in our boot camp program, or I don't remember which exact program you're in? But I can certainly do some more head to toe education on the bond market for in the boot camp in the near future. Tomorrow, we're going to be working on filling out our spreadsheet so you have the same setup I do. Randy too says, get the sprayer like they use in Thailand. No need for toilet paper. Oh, smart. Okay, DD, you're in pro. Okay, yeah, I'll try to see if there's any just good YouTube channel. There's a lot. There's really a ton of great education on there. If you just probably went to like, I think Khan Academy has some good stuff. There's a lot of good courses on just the basics. It's really putting it all together that's what I help. Jeff says, would you buy a call on GDX? No. The price action on GDX really has me concerned. Luckily, we only have 10%. So this 5% pullback today is only a half a point on our total return. I like the fundamentals. I think we're early in the gold play. That was the big epiphany I've had as I really think this through, is that I think we're going to see a lot of people believe that we've hit a top in the bond market way too quick because they've underestimated the damage to the economy that's going to have to be absorbed through the government bond market. DD says, can we start a member blog for us chit-chatting with Trade Talk? That's a good idea. I'll consider that for sure. Yeah, Jeff, I think the outperformer is just really simple. I think it's going to be TLT. And so, you know, there's some things to be concerned about, which I'm closely monitoring. But yeah, I think right now, you know, if I thought that it was time to do a GDX call, I'd be issuing a GDX call. See, would anybody else like to unmute and talk out loud? Mark B says, two of the most outstanding things about this program. One, your ability to hear your commentary. I'm struggling without Tuesdays, but getting through it. Two, the education, like Dee said, about getting your mind around the bonds, not easy. Oh, thanks, Mark. Yeah, if you guys really want to learn a lot, you got to realize this is a large commitment from you when you join the boot camp. I keep you very busy, and I give you not only a lot of my own content, but also content. I'm probably getting through 10 hours of content a day. And on weekends, more than that. And I'm going to go pull out the best of the best that's related to what we need to learn right now, and giving you that assignment on Tuesdays. And then we're doing our 2-hour webinar on Thursdays. So, you know, it's something that if you really want to learn it, you're going to have to make the commitment. It's a huge time commitment. And only do it if you love it. It's a mixture of, you know, what are we having to understand in this current environment? We have to have a good understanding of how the government funds itself, how the Federal Reserve acts and coordinates with other central banks. We're having to have a pretty good understanding of what's going on in the political spectrum. We had to have a little bit of a palette for conspiracy. Otherwise, you wouldn't have seen this come in a million miles away. And then you had to have an interest in science. So all of those combined is what allowed me to call this out at the very, very top, well before it crashed. So I've been ringing the alarm bell for quite some time. But yeah, if you love it, you want to really dig down deep and fascinated with learning, that's who should join the boot camp. If you just want to follow the trades and make money and get the general swing of things from these webinars, that's what the advisories are for. Michael Seebeck says he's stepping out. Talk to you later. You're welcome, and thank you very much. Boy, what's the limit? I don't know if Dean's still on here. I think, what did we say is the limit down? What is it, 7%? We're about to hit the breaker on the stock market. Let me look that up. Yeah, Josh, sure. Let's unmute Josh, Ryan. Mark, what's the limit down? Do you know?
I think the first one's 7%, and then the second one is like 13 or 13.5.
Holy shit! So we're 2% off from hitting the circuit breaker on the SPY. Wow.
How long does the circuit breaker thing last? Like, is it 24 hours? Is
I
it?
think it's 15 minutes, right, guys? Let me.
Yeah, I think so.
Yeah, I had a chart, just so you know, it rarely happens in history. Yeah, so it'll only turn off for 15. I think if it does a second circuit, it might last longer. I mean, okay, so here's the rules. Level 1 halt halts 7%, 15 minutes. Level 2, 15 minutes. Wow. Okay, so if we drop 20% total, we're gonna halt for the day. Wow.
Does the halt does like the statistics reset every day, or is it like a consecutive thing?
Yeah, I believe it's intraday.
Yeah,
Crazy.
I was gonna ask if what would happen if like I know they were talking about Trump doing some sort of stimulus, like the tax holiday or something like that, or like what I'm wondering is like what happens if they announce some sort of large stimulus plan and let's say the Fed cuts the rates by 50, 75 base, let's say it cuts by 75 basis points, and then the market still doesn't recover. And then they do some sort of stimulus plan or whatever, or a fiscal stimulus. Do you think that would affect the bond market? That's one question. And the last question is, what about? I read somewhere that like if all the world markets are going down, the U.S. market is poised to go down the least of comparatively to the rest of the world markets. And if investors were going to invest, they would invest in the U.S. because it's poised to recover the fastest if it goes down the least, or something like that.
No, I think that's wrong. I think US market will crash the most, and okay, well, let's just do one question first.
Yeah.
The government has to stimulate the economy. They're going to throw everything they can at it. Tax cuts, helicopter money, bailouts to oil companies, bailout to airlines, bailout to banks. They're going to have to bail out the health insurance is going to go bankrupt from this. They're the first ones who are going to be in trouble. They'll probably have to nationalize the healthcare system to deal with this. So government's going to spend trillions and trillions of dollars. Okay, so normally if you are taking on debt as a normal consumer, what happens to that debt the more money you borrow? Does interest rate get less expensive or more expensive?
If I take on debt, then yeah, it would get more expensive.
That's what should happen, right?
Should, yes.
Okay, but in our setup with the central bank, the exact opposite will occur. The more debt that governments need to bring in, they will artificially push the interest rate cheaper. And that will incentivize bond investors to buy the debt. Because they know at the end of the problem being resolved, that's when we do QE. They get to sell those bonds for a big profit. And that's how the Fed and the banks operate. So yeah, I expect massive stimulus. They will play it as positive for stocks the whole way. And I would assume your CNBC cheerleader is going to keep telling you to buy. That's their job.
You were talking about the repos, like which one? What's I know the Fed gives the overnight, they give the money to the banks to stimulate lending. What's the thing where like I heard like when the Fed gives the repo money, the banks are supposed to, then use that money to stimulate, to give more loans, but instead, like over the last 10 years, they themselves will buy the treasury notes, and then the Fed has to buy the treasury notes to get them to not buy the treasury notes or some weird stuff like that.
Well, the US government's goal is to export debt worldwide. And so that's their goal. That's what they do in a good situation. So if we can't export if there's rainbows, here's kind of how we simplify it. If there's rainbows and ponies, economy's healthy, government has a hard time selling debt because everybody wants to invest in stock market for a better return. Okay, so government has to pay a higher level of interest to attract enough money to fund its deficits. Okay, so if everything's gravy train for the economy, then the value of bonds falls like the TLT and yields rise to become attractive enough for people to just want to outright buy the bond for the yield and for insurance against economic slowdown. So right now, there's a massive crisis. So government's going to sell this debt easily because investors know that we're going to cut rates to stimulate the economy. So it's just really that simple. Until the underlying problem is resolved, the government's going to have to create fiscal spending to try to absorb all these losses, bail out airlines, cruise ships, anything important and critical that has a huge labor force. Expect the government to try to protect those markets. So yeah, it's completely backwards thinking, but that's just the way it works. So rate cuts to incentivize bond investors to buy and hold treasuries. The repo is really the safeguard for the US banking system. When we're not able to sell these treasuries to foreigners, then our primary banks must buy these treasuries. That's their arrangement. And so they could.
So it's an actual arrangement, like.
It's a law, yeah. They have to.
Oh, okay. The way I was reading, that's why I didn't understand it. Because the way I was reading it, it seemed like the Fed was giving the money, and then they were supposed to.
The Fed can't buy the debt from the government. They can only buy it in the open market.
Uh-huh.
So they're supposed to be buying old debt, but they're buying. So right now the Fed is using $40 billion a month to pick up the front end of the yield curve, which will roll off in less than a year. So even though the balance sheet's increasing in the short term, that debt will roll off and the balance sheet will go back down. So it's not necessarily negative for the dollar because it's all going to roll off. What's negative for the dollar is permanent expansion of the balance sheet.
So when they do the repo, is the Fed giving the banks actual money, or is the Fed giving the bank notes?
Exactly. The banks get dollars, the Fed holds the treasuries.
Got it.
And then they give it right back. So the banks only use repo. After the 2008 crisis, they increased regulations dramatically to make it harder for banks to overextend themselves to prevent something of the nature that we saw in 2008. So what that means is we've quickly become out of cash. So the banking system would freeze without this repo. So it's a short-term expansion of the balance sheet that will reverse at the end of the term, which are currently very short-term. So I'd expect to see repo expand the different expiration periods. So more duration in repo and larger quantity as we start to start passing bigger and bigger fiscal spending plans to absorb all these losses that we're about to incur and try to keep the labor market from collapsing.
is there any truth to like the banks taking the money that the Fed gives them, and instead of giving loans to the public, which are riskier, like going out and buying treasury, like extra treasuries that they're not supposed to, because of like, like getting a guaranteed interest rate versus.
Yeah, we have a top-down system. So the Fed lends to the primary bank lends to the medium-sized banks and to large broker dealers, and the broker dealers then in turn lend to the hedge funds and the retail. So I think most of this money related to mortgage or to the repo is flowing right into the broker dealers, where you have these hedge funds playing with big money and using a lot of leverage.
That's the leverage loans thing.
So just like if you logged into your trading account, you could probably get 2-to-1 leverage at a relatively low interest rate, not 1%, obviously, but yeah. So it's the margin that you're able to use in your brokerage account. That's where this money's flowing to.
Got it. One last question. Can you explain helicopter, what that helicopter loans is?
Helicopter money is when the government sends everybody cash to stimulate the economy. So we saw Bush do this at the end of his term with, I think it was $2,000, and it didn't have a lot of effect. Hong Kong just gave every citizen $10,000. So the idea is if we have to go into a slowdown and lockdowns in certain areas where there's hotspots, then these people may want to go to work even if they're sick because they can't afford to not work. So we're going to have to provide stimulus in the form of helicopter money, is the catchphrase, to basically prevent people from obviously starving and failing to make their mortgage payments or their rent, and to incentivize social distancing. So yeah, I think we're going to see some pretty remarkable actions by fiscal and federal, the Federal Reserve and the US government's going to have to get very creative here to try to keep this all from falling apart in the very, very short near future. So, I mean, where were we at just like a day ago in America? We were at, it wasn't long ago, we had less than 50 cases. Now we're at 1,000. So this is just going to grow rapidly now that the tests are slowly getting available and the public's demanding the ability to just test if they want to, not to be at the leisure of some state official who's being ordered to stand down and block testing.
That makes sense. Thank you.
A couple questions on the chat box.
Okay, let me pop that up.
Thank you for answering all my questions. I really appreciate it. Sorry I asked so many.
William says, why is TLT flat and SPY down? Well, they're two different markets. So people are still selling the TLT. And yeah, stock market's about to, well, it's down 5%, but yeah, it's on the verge of hitting the limit. So yeah, that's one of our concerns, William, is, what could happen to the TLT? Well, if the TLT crashes, then this entire thing comes unglued. So one concern would be if China was trying to attack the United States and was able to buy up enough of that 30-year treasury and then just sell it as rapidly as possible with all their allies in the open market, that could create a yield spike, at least in the short term. Now, in the long term, I believe that with necessity of survival, the government must issue massive amounts of treasury debt and incentivize that investment. So there's two options. Either the yield gets attractive enough to be highly attractive by just buying and holding that bond. Okay, but the catch there is if the yield rises, That asset has $800 billion currently invested. If the yield rises, then one, the person who bought it at a lower yield is still getting that lower yield. And two, the value of their bond is losing money. So it's going to incentivize selling the bond. So that would actually, at least in the short term, if the government and the central banks allow the yield to rise, that would incentivize selling the TLT, or the 30-year treasury. Okay, now if the government needs to borrow money, why on earth would they want to incentivize selling the treasury product? They don't. So my expectation is there's some people losing a fortune and liquidating everything, which most investors have a half bond, half stock portfolio or something of that nature. Josh says, for how much TLT is going down, the option values are holding up. Applied volatility isn't dropping with the value. Yeah. So this all just points to me that there's some very serious underlying problems in the economy that will have to be resolved with the government. Mark says, why not ladder out TLT puts over a period of out of the money puts? There's a lot of ways to skin the cat. In our pro system, I prefer to own the actual asset. And for the basic membership, we're using call options, which are performing very well for us. But yeah, there's a lot of ways to trade the same concept. I try to take the most basic, simple one that has the least risk and is the easiest to follow, and simplify it for our group. Now, a lot of people are always like, oh, the SPY is shooting up. Is this the end of the crisis? But remember, if you sell a put option and you go underwater, at some point you have to cover the loss by buying the SPY. So then the question is, do you hold, or do you think there's more downside ahead? If so, you sell. And that creates another whiplash further down. So if you assume that we have to take the same fate as other countries, which is essentially locking down parts of your economy, you got trouble ahead for stocks. It's pretty easy calculation. And if the government's going to prevent these companies from going bankrupt, then they're going to have to borrow money. And in order to borrow money, we cannot let the $800 billion already holding that 30-year treasury hostage escape. We need to incentivize investors to buy and hold this debt for a much longer period. So that means we need to drive interest rates lower so that we can accumulate resources from the global economy and then put it into the market. I'm going to let the TLT put, what's it worth today, William? Is it worth anything? I just marked mine as a value of 0 and letting it expire in my account. But if you can get something off of it, probably a good idea. But then you lose that protection through Friday if something really bizarre were to occur.
It's actually gone up today.
Yeah, what's it worth right now?
The mark is 46 cents. I didn't look at the.
Oh, on that TLT put?
Yeah, it's $8 ask or bid and $8.45 ask. That's
Oh,
look at the wrong one. Sorry. It is
that old put?
42 by 50.
Oh, our old put's worth 50 cents, huh?
On the ask.
I would rather just hang on to it and have a little insurance in case something completely outrageous happens on the position, but it's up to you. I haven't sold it in our account and intend to hold it to expiration. And I think it's highly unlikely that we would see the bond market. So that's the biggest fear, is if the bond market and stock market crash at the same time, it would wipe out the US financial system. We really need the bond market to be protected if the stock market's going to pull back. No, good question. And I know some people did sell it for like 6 cents. But yeah, unfortunately, the only way out of this is to, for globally, all central banks are going to just start gradually driving interest rates lower, incentivizing money to flow into bonds to hold, with the intention that after the crisis is resolved, that all the central banks will do QE and vacuum up all these bonds, which, you know, yield close to zero or nothing. And so they're going to make their money on the appreciation in the bond value and not from the worthless yield. If that doesn't happen, then there won't be a way to fund the debt that the government needs to take on. Unless they, you know, the other option is you get all of the money in the bond market freaking out, selling, yield spike. Now the interest to the public is elevated to outrageous levels. So that outcome seems highly unlikely. Let's see. So we went for almost 3 hours, guys. I think that might be a new record for us. Any other questions out there? My best guess, William, is that the smart money is trying to load up on the leveraged 30-year product at the cheapest prices they can, knowing full well what's coming ahead. So that's my best guess. Now, if we don't see the TLT start to appreciate and the stock market keeps crashing, we'll have to reevaluate what on earth is going on here. But if the TLT does not go up as stocks crash and this crisis unfolds, we're in for a much bigger problem. And of course, I'll be the first to conspire as to why the hell that would be happening and change course. But I don't, there's just too much money. The super rich know the game plan. Very few people understand corporate bonds are not going to do well in this environment. I would only buy the 30-year treasury, period. That is the top shelf bond product in a crisis, with the most leverage, the limited supply, with the most potential gain. So if you think of it from a greed standpoint for banks, then yeah, so the big money is going to be, the huge money to be made is dropping this yield on the 30-year lower. Oh, you're welcome, Josh. He says, thank you for, Mark says utility. Yeah. So market manipulation is going to be very misleading in the short term here, but the overwhelming pressure is that the government must borrow not billions, trillions of dollars to resolve the underlying problem. In order to do that, they must make the value of bonds appreciate over the course that they believe they need to borrow this money. If they believe this needs to be borrowed for the course of a year or two, then you can kind of timeline out how long they're going to borrow the money for and how long they're going to continue to lower rates. Mark says 21 trillion. that's a lot of, who knows? It's going to be an obscene amount of money that needs to be borrowed. So far, they've only approved a $8 billion plan, which is a joke. And they're not going to be able to borrow it all at once. So really, it's in their best interest to slowly grind the TLT higher over the period they think this will take, and to only use the money they need as they need it. And that will allow them to borrow the most money for the least interest and have the most time on their side. So that's why I like the at the money TLT call options and our current strategy in terms of 40% allocation in the TLT. All right, guys, I'm gonna go ahead and wrap it up. Just put our disclaimer on the top, just so don't have any authorities giving us a hard time here. If anybody wants to read our disclaimer or terms of use, it's at the bottom of our website. So you can go through the terms of use and risk disclaimer. And that's a wrap. Thank you so much, guys. We'll see you on our Friday webinar if you're in the trial. And if you're in the pro membership tomorrow, we'll give you an update on how to play the other half of your portfolio.